Hello traders, welcome to this video. In this video we are going to be discussing three powerful gold trading strategies which you can use to enhance your trading decisions, right? And each of these strategy is designed to help you maximize your chances in the gold market, although they do not guarantee profit, but they are useful strategies which can assist you in catching good moves in the gold market. So the first strategy that we are going to be considering is the price action trading strategy. Now, as we all know, the price action focuses on interpreting raw price movements. Price action traders focus on the raw price movements without the use of any lagging indicators. Price action for gold trading involves analyzing support and resistance levels. Support levels, resistance levels. Basically, the price action trading strategy focuses on support levels and resistance levels. Also, we also make use of trend lines for this strategy. Trend lines indicate dynamic support and resistance levels. You can see we make use of trend lines, we make use of the horizontal resistance and support levels, and we also make use of key candlestick patterns to determine entry and exit points. Candlestick patterns such as the hammer, we can see the hammer. In a previous video, we have discussed the hammer candlestick pattern. We have discussed this is another hammer here. Then we have also discussed the doji. We have discussed doji. This is a dragonfly doji or a hammer around here. We have discussed a couple of candlestick patterns in previous videos. You might want to check them out. So the candlestick patterns also help in our price action trading to determine entry and exit points. We also make use of the engulfing patterns, make use of this example is an engulfing, a bearish engulfing. It swallowed up the previous candle, and this is a sign of a bearish move. So there are several candlestick patterns. Now, how do you use the price action trading strategy? First of all, you need to identify key levels. Look for areas where the price has consistently bounced or reversed, which are the support and resistance levels. This is the 1 hour time frame on the gold chart. As you can see, I already identified the support level here and the resistance level here, a resistance zone. Remember, these are just zones. It might not bounce off exactly at the line. It might not bounce off exactly at the line. It could bounce off above, it could bounce off below, it could bounce off around the line. These are zones, right? So after identifying these key zones, then you need to watch out for candlestick patterns such as the hammer or engulfing patterns around those zones. For example, we can see that around here we had an engulfing. This is a bullish engulfing right after the support level. So after this bullish engulfing pattern which swallowed up the previous candle, we can enter a buy trade right after that and then set our stop loss just below the support level, and then for our take profit is going to be at the next resistance level. So basically that's it for the price action. When you identify the key levels, you look for a candlestick pattern. It could be engulfing, it could be a hammer or an inverse hammer for a sell, it could be a morning star, it could be an evening star, it could be any candlestick pattern at all that indicates a reversal. And once you have found that candlestick pattern, you can enter a buy trade like this example, set stop loss below the support and the resistance level is going to be your take profit. Now, as for a sell trade, when you identify a resistance zone, the next thing for you to do is to wait for a sell candlestick pattern or a bearish candlestick pattern to form. Wait for a bearish candlestick pattern to form, or just look for signs of reversal. Perhaps after waiting for the first bearish candle to form, we would have waited for another candle just to be sure if this bearish move is valid. Okay, and we can see this inverse hammer here, this inverted hammer, the bearish candlestick pattern. We can see this inverted hammer. We would have entered a sell right after that, and then we would have set our stop loss above the swing high or above the resistance, though it has to be above the swing high, and then our take profit would have been at the next support level. This, although there is another support level here, so some traders might have decided to exit their trade somewhere around here, while others might have decided to wait until the next resistance, or whatever the next support I mean. So you could have entered a sell trade right after this inverse hammer and then exited your trade here, stop loss above here. Now, another example using the trend lines, you can see that after an inverted hammer formed here, we would have entered a sell trade here and set stop loss right above the candlestick pattern or above the dynamic resistance, which is going to be here above the dynamic resistance, and then that would have been perhaps about 58 pips, and then our take profit level is going to be at the dynamic support. The dynamic support, since we are using the trend lines, you set your stop loss above the dynamic resistance and you set your take profit at the dynamic support, right? And that would have given us somewhere around 274 pips. So you see, we would have been risking about, say, 60 pips to make about 250 pips. Okay, so that's a great win. Now, as for the next strategy that we can use for trading gold is the Fibonacci retracement strategy. So I'm just going to remove these lines. Okay, the Fibonacci retracement strategy is often used to identify potential pullback levels in a trending market. By drawing Fibonacci levels between recent swing highs and lows, traders can spot where gold may be retracing before continuing in the same direction. So first of all, when using the Fibonacci retracement strategy, the first thing to do is to draw your Fibonacci levels, right? It has to be in an uptrend. So this is an uptrend. We can see this is an uptrend. So let's draw our Fibonacci level, Fibonacci retracement, and then you have to look for key retracement levels such as the 38.2%, the 50%, the 61.8%. These often act as potential support or resistance points where price may reverse or bounce. So we can see that in this bullish move, after the price got to this point, this is our point A, this is our point B, you can see that the price of the gold asset retraced to the 61.8% level, the Fibonacci level 61.8, before it continued the bullish move, right? So using the Fibonacci retracement as our tool for determining our entry points, you will have to wait for the price of gold to retrace to either the 38.2, 50, or 61.8% levels. If it goes below 61.8 towards here, then you shouldn't enter the trade anymore, right? So now you have to look for price to react strongly to one of these levels. Now, how do you know whether price is about to bounce off, whether it's at the 38.2 or the 50 or the 61.8? You can see that when price got to the 38.2, it continued moving downwards. So we would have waited still. As it got to the 50, it continued moving. We would have waited still. And when it got to the 61.8, you can see that there was rejection and a doji even formed after that. So that would have been a good opportunity to enter a buy. So we would have entered a buy trade around here, set our stop loss below that low, below the rejection, right? And then our take profit could be at the 0% level. At the 0% level can be our take profit, right? Now, because that 0% level also indicates a resistance, levels. But if you want to ride the trend, then some traders would prefer to just trail their stop loss right after the price crosses above the zero level. You can decide to trail your stop loss so that in case of if the price begins to reverse, you would still close in profit. Okay, now the next strategy that before we go into the next strategy, for a sell trade, it is just the opposite. It's just the reverse for a sell. After drawing your Fibonacci level, let's just use this as a second example. After drawing your Fibonacci level, you wait for the price to either bounce off at the 38.2, at the 50, or at the 61.8. So you can see that when price got to the 38.2, it was still going up. Got to the 50, it was still going up. Then after price got to 61.8, we can see this bearish reversal candlestick pattern here. We can see this inverted hammer forming right on top. So this would have been an indication of a sell. So we would have sold right after the formation of that candlestick pattern and set our stop loss right above the candlestick pattern, and our take profit could have been around the 0% level again, right? Or if you wanted to ride the sell, then you can trail your stop loss after the price crosses the 0% level, so that even if the price begins to reverse, as in this case, you would have still closed in profit. Okay, now the third strategy that we are going to be looking at is the scalping strategy for gold. The scalping strategy for gold. Now, basically, scalping is a high frequency, low duration strategy where traders aim to take small profits from rapid market movements. Now, for gold, this often means entering and exiting trades based on short-term price fluctuations, sometimes within minutes. Of course, gold is a very volatile pair. The XAU USD is a very volatile pair, and that is the reason why scalping is one of the most common strategies that is used for trading gold, because within minutes you can make a lot of pips within minutes, but if you do not know what you are doing, you can also lose a lot of pips, right? So that is the reason why you always have to put in place proper risk management. Now, how do you use the scalping strategy? For this strategy, we have to go down to smaller time frames, right? You can go to smaller time frames like the 1 minute or the 5 minutes time frames where you can see more rapid movements. So now this is the 1 minute time frame. For example, we can use the 1 minute or the 5 minutes. Let's just use the 5 minutes for this video. Okay, now the next thing to do is to look for micro trends, like tiny trends, little trends, right? Now you just have to wait for quick price movements. You can look for whenever you see the market reacting like a sharp moving price. For example, here you can see that there was a strong momentum at this point. So you just have to enter your trade in the direction of the momentum, in the direction of the energy that you can observe. So as we saw price pushing downwards, we would have just quickly entered a sell, probably somewhere around here. But one thing to note about this scalping strategy is that you might not really have much time to calculate your stop loss and take profit levels, right? So all you need to do is that you have to be quick in making your decisions. Okay, so once you notice a bearish momentum, you could have just entered a sell, and then once you notice a reversal, like a sign of a reversal, you exit your trade immediately, right? But after entering the sell, You can also decide to set your stop loss right above the nearest swing high, Then you watch out for when a possible reversal is about to happen, and you exit your trade, which would have exited around here. So perhaps we would have caught about 160 pips if we had taken this trade. Now another example is seen here. After noticing a bullish momentum, we would have just quickly entered a buy. Remember, this is a scalping strategy. It's based on very quick decisions, right? So we would have entered a buy here, and remember, just below the nearest swing low, the very nearest swing low. So we would have set our stop loss right below here, and then as the price was going up, we would have exited at the sign of this inverse hammer that formed here. Or perhaps if we had entered after this, entered a buy here, at the sign of this candlestick pattern, this bearish candlestick pattern, we would have exited the trade. Actually, we would have given us about 30 pips. Then after the bullish energy resumed, we could have entered another buy trade. Remember, scalping involves making quick decisions, catching a lot of small price movements. Okay, so we would have entered another buy trade here, set stop loss right below this candlestick pattern, and then at the sign of this inverse hammer, we would have closed our buy trade. Okay, so your targets are always tight. You need to set tight targets when scalping on gold, right? Because the market is really volatile, so you want to just be capturing small price movements. When you enter a buy trade at a sign of a sell pattern, you should exit your buy trade. When you enter a sell trade at the sign of a buy pattern, you should exit your sell trade. Okay, you want to avoid staying in the market for too long when scalping. So basically, these are three good strategies that traders use for trading gold. These are three strategies that can help you maximize your chances of success in the gold market. But always note that none of these strategies guarantee profit, as it is usually a common occurrence in the forex market. No strategy at all guarantees profit, so you want to make sure you trade with an amount that you can afford to lose and observe proper risk management. So by combining the price action trading strategy, the Fibonacci retracement strategy, and the scalping strategy for gold, you can be able to build a more comprehensive approach to trading gold, depending on your risk tolerance and your trading style. So that is it for this video, guys. I hope you found it insightful. Kindly like and subscribe for more. Cheers and happy trading.